There are numerous mistakes that casual investors commonly make that hinder their ability to maximize profits. First, people usually don't understand how important investing is and what impact it will have on their finances over time. So, they fail to do the proper research. Second, most people don't understand that most of their wealth will come from the investment game, not working and saving. So, wouldn't it make sense to prioritize becoming a better investor? Investing doesn't have to be complicated or time-consuming. And some profits can be achieved by just abiding by a handful of principles. These are the 8 most common mistakes that investors make that cause the loss of extreme quantities of money. But before that, welcome to our channel. Make sure to subscribe to the channel and press the bell icon. If this video helps you a bit, hit the like button and share it with others. Now let's get back to the video. Number 8. Being overconfident. It's an empowering feeling to think that it's possible to beat the market. Well, it's true that it is possible. Most people don't have the proper knowledge to do so. You might get lucky in a Starker tube. However, what is the possibilities that you could outperform the market time and time again? Analysis of the stock or various other types of investments requires a substantial amount of understanding regarding risk calculation to figure out a reasonable value for an asset. Just choosing an investment based on suspicion is absolutely nothing more than gambling, as well as it's most likely to result in loss. If you don't know to value a stock with a high degree of certainty, stay with something you understand will undoubtedly be profitable. Number 7. Paying too much in fees. Fees never make or damage their portfolio, but they will absolutely impact its value over time. Yet, paying too much in fees is usually a minor consideration and shouldn't be the reason not to invest at all. Many investment choices charge a little to nothing, with companies like Vanguard, Fidelity, Invesco, and many more. These fees are called expense ratios in their charge, based upon the value of your portfolio. For example, if you are paying a 0.3% expense ratio and a $1 million portfolio, that's $3,000 each year. Also, companies charge fees in form of a commission, which is charged every time you execute a trade when buying or selling. Fortunately, this commission is becoming much less and also less commission in the past 5 or 10 years. Some companies are still charged for trades. So keep that in mind. There is no reason to stay with a brokerage that charges commissions for trading when there are many free, trusted trading options. Number 6. Buying and selling based on emotion. This is a mistake that cost investors a lot of cash, especially during the occasional market correction recession. When our investments increase in value, it feels great, and most of us want to purchase much more. When they drop in value, it has the opposite impact on our emotions, making us want to sell and put that money in savings accounts. As a rule of thumb, you need to be buying and cost drop. Emotions not only control when we purchase or sell, they also impact what we select to invest in. You may be caught up in the excitement of new investment and rate a buy due to the hype. This can lead you to invest in assets without exercising due to diligence or completely researching. The possibility of making huge returns can sometimes overcome rational thinking and risk-reward assessment. Number 5. Buying when everyone else is. By the time an investment is so popular that everybody is buying it and the rate goes up as usually and it's already picked. If everyone is purchasing, you are late to the party. There is an old adage, it says, if your cab driver is talking about investment, it's time to sell. In general, people get excited and buy after an asset has had its run up in rate. The key is to seek out those investments before they become popular. If you don't have the time or interest to discover those possibilities, it's best to stick with something much broader, like index funds as well as ETFs that track the market. Number 4. Thinking you have to beat the market. It's certainly an accomplishment to beat the market, particularly reliably every year. This is how Warren Buffett becomes so wealthy, right? For most people, beating the market is an unreasonable and unnecessary endeavor. The reality is, lots of people don't have the time or drive to do the research needed to choose an excellent investment time and time again. Buffett reportedly spends nearly his entire workday reading as well as learning. That's not possible for the people who are working full-time and don't have a serious interest in the topic of investing. Also, market returns can be successful as well as they are less risky. Somebody who is an expert on investing should not choose their own stocks or other investments. In many cases, simply keeping up with the market, utilizing an index fund or ETFs is all you require to be successful, which will allow you to focus on things you are good at. Number 3. Blindly trusting financial professionals. It's a little frustrating to think that you are not in the best interest of your financial advisor. Many of them are paid based on commissions from the product they sell, in the same way a car dealer earns money by selling a long service program. We would like to believe they are looking out for us, but a lot of the time they are thinking about lining their own pockets. This is why it's so vital to have some financial knowledge at least. There are many well-intentioned, honest, good people doing their best. However, lots of so-called experts are confused regarding financial investments similar to you. Number 2. Not having enough patience. Many people expect instant growth of their portfolio or have no tolerance for a short-term drop in value. This is specifically common with younger, unexperienced investors who are hoping to strike it big. The truth is, achieving regular growth investments takes some time as well as patience. It's normal to see little to no growth for 1 year or even more each time, to experience 2 or 3 years of gains in one single year. A slow, steady and disciplined method will go a lot further over the long haul than expecting to earn an immediate profit. Keep in mind that this is not to be confused with accepting subpar returns regarding the overall market. Number 1. Waiting too long to start. This is perhaps the single largest and also most usual mistake made when it comes to investing. We all understand the time is on our side when it relates to compound interest. And also, the earlier you begin, the much easier it is to expand wealth. Unfortunately, many people fail to understand the value of just dedicating to investing, despite how small on a mountain you start with. You might believe $25, $50 or $100 is insignificant, as well as it might be in present dollars. Yet, those little amount will grow greatly. Don't put off investing. Waiting until you have more money to invest is equally as absurd as saying you will place wood on the fire as soon as it provides warmth. People don't invest because they have too much money. They invest because they want a lot more. There are several excuses that people use to discuss why they have not started investing yet. Like, I don't have enough money, or I don't understand what to invest in. The bright side is that just about anyone can start investing with a small amount of money to make reasonable returns with an index fund or ETF that tracks the S&P 500. It doesn't get much simpler than that. Most of us wish to make the most of our money and see it grow quickly. But you want to be smart about your investing choices. Begin investing early to maximize interest earned. Never convinced yourself that it's not worth investing a small amount of money. Just preventing that simple mistakes can assist you to be a lot more successful investor. It will certainly also help you be a lot more content when your portfolio is not executing as well as you would like. Over an entire career, there are going to be times when you are not happy with short-term price fluctuations. This more than likely has nothing to do with your particular investments, but how the overall market is behaving. Keep in mind, investing is a long-term game. It takes years to build a sizable account, but making one simple mistake could risk it all. Learn from this as well as common behaviors you can maximize your wealth. And that's all I want to show you in this video. Let us know which mistake you made in your investment portfolio in the comments below. If you get value out of this strategy, hit the like button and share it with people. If you enjoy this kinds of videos, subscribe to our channel and turn on the bell button. Thanks for watching, and I will see you in the next one.